There are many different ways to structure your loan when purchasing an investment property, and the way you choose to structure your loan will have a significant impact on the return on investment that you achieve on your investment property. So it is important to get your loan structure right and to choose the loan structure that is best suited to you. Hi, I'm Ryan McLean and I'm from positivecashflowaustralia.com.au, where we teach people like you how to find and invest in positive cash flow properties all over Australia. Principal and interest, interest only, variable rates, fixed rates, buying in your own name versus buying jointly with a partner, and what about investing using trust structures? All of these different loan structures will have an impact on the way that you make money in property and how successful your property investment is going to be. So let's have a look at the different loan structures that you can use, and then you can go and assess which loan structure is going to be best for you. Just a quick disclaimer that I am not a financial advisor, so please speak to a professional mortgage broker or financial advisor when making a loan structure decision. Let's first look at principal and interest versus interest only, and then we'll go on and look at variable versus fixed interest rates. So what is a principal and interest only loan? Principal and interest loan, sorry. A principal and interest loan is when you are paying the interest generated on the property, so that's the amount that the bank is charging you for having the loan, but you are also paying down some of the principal. Now the principal is the amount of debt that you owe on your mortgage. So with a principal and interest loan, you are paying the interest and you are paying down a portion of your mortgage at the same time. With a principal and interest loan, you will usually sign up for a fixed term. So what that means is that you will sign up for maybe 20 years or 25 years or 30 years. And what that means is that within that time frame, that is how long it will take you to pay off the loan fully. The benefits of principal and interest loan is obviously that over time, your interest decreases because the value of your loan decreases, and eventually the loan is fully paid off, meaning you own the asset completely and your cash flow gets a boost because you no longer have to pay a mortgage. This can be great if you're risk averse or if you don't want the fluctuations of a loan, because if your loan is completely paid off, then you own that asset yourself and the bank has no control over that. Interest-only loans are exactly what they sound like. They are loans where you only pay the interest on the property. In these circumstances, the bank charges you the interest for having the loan and you pay that interest, but you don't pay anything off the principal. So if you have an interest-only loan for 5 years, then at the end of 5 years, the value of your mortgage is going to be exactly the same as what it was at the start of that loan, because all you're paying is the interest and the bank fees. The benefits of interest-only loans for investors, and why many investors choose interest-only loans, is because interest-only loans can maximize your cash flow in the beginning. With the principal and interest loan, you're paying interest and then you're putting extra money onto the loan as well. Well, with an interest-only loan, that extra money gets scaled back and you actually keep that in terms of cash flow. So your monthly repayments are going to be smaller. This can mean the difference between having a positively geared property and a negatively geared property in the beginning. So many investors choose interest only because it decreases the amount of money they have to pay and increases their serviceability of that loan and other loans in the future. Another benefit of interest-only loans is that they maximize your tax deductions over time. Because your mortgage is staying the same, ideally your interest is staying the same, except when interest rates change. And so therefore, you are claiming the full amount that you can of that interest on a tax deduction. With a principal and interest loan, over time, your mortgage goes down and your interest goes down. So what you can claim as a tax deduction goes down over time as well. So interest-only loans can be great for maximizing those tax deductions. Many investors will take the money that they would have spent on the principal of that investment property, which would lower their tax deductions, and they use that money elsewhere. So that's something to consider, but obviously speak to a professional before you go ahead and make any of these decisions. This is not to be considered financial advice, but educational purposes only. Okay, so there we have the differences between principal and interest only. And now let's look at fixed versus variable loan structures. And we'll go into part 2 and we'll look at buying in your own name versus buying jointly. And we'll also look at trust structures as well. So fixed versus variable. What are the differences and what are the benefits of each? First, let's look at variable, which is the most common way people structure their loans. A variable interest rate is just as it sounds, it's variable. It can change over time. So as interest rates change in the market, your interest rate changes as well. If interest rates are going down, then your interest rate will go down and the amount of money you have to pay will go down as well. But if interest rates are going up, then your interest rate will go up and then the amount of money that you have to pay will increase as well. Variable rates are great because you're maximizing the savings if the market goes down, and you can also pay off more money on your mortgage than if you have a fixed loan as well. So if you get an extra influx or you get a bonus and you want to pay off your mortgage faster, then variable loans tend to allow you to pay extra money off your mortgage. A fixed loan is just that. It's a fixed loan. You fix the interest rate. It can be for 1 year, 2 years, 3 years, 5 years. 5 years is generally the maximum that people do fixed loans for, but I'm sure there are some lenders out there that offer longer term fixed loans. But with the case of a fixed loan, what that means is your interest rate stays the same, but there are also limitations on your loan as well. Fixed loans can be great because you know exactly what you're going to be paying every single month, so you can predict your cash flow in advance and what you'll have to pay in advance. But fixed loans do have their limitations because you can only pay the amount that is set, and generally you can't pay on top of that, or you are limited in the amount of money extra that you can pay off your loan. So it's much harder to pay off your loan faster if you have a fixed loan versus a variable loan. Another benefit of fixed loans is that if interest rates go up, then your loan is set, your loan is fixed, and so you are maximizing your benefits there because you're getting a lower interest rate than everyone else. So there's fixed and variable, so I hope that gives you some idea. So you need to look at, when choosing your loan structure, you need to look at whether you want to go principal and interest or interest only, and whether you want to go variable or fixed. A lot of investors will start with interest only, and then what will happen is over time the rents of their property will go up and their cash flow will improve, and then they will shift from interest only to principal and interest, and they will start to move some of that cash flow to pay off the loan over time. So a lot of investors do that, go interest only and then move it to principal and interest, but what you do is up to you. And then there's fixed and variable. Some investors choose to go half-half or to fix a portion of their loan and make a portion of their loan variable so that they can still pay off some of their loan faster, even though they have a portion fixed. So a lot of investors go with that route as well, but it's really up to you. I do suggest speaking to a mortgage broker or to your financial planner and to see which loan structure is going to be best suited to you. But this should give you some ideas and at least give you a starting point of what you have to choose from. If you want more videos, articles or podcasts just like this one, then head over to positivecashflowaustralia.com.au. Or if you're on your mobile phone, you can type in pca.im, which is a short link that'll take you directly to the website. Until tomorrow, which is when the next episode's coming out, stay positive.